Good morning, everybody. I hope you're all okay. All looking forward to the week ahead. I'm actually recording this on the Sunday today, due to the fact that, as you can probably tell by the attire, I'm out for a game of golf today, and there could well be a few beers afterwards. So I thought I'd rather get it out of the way and get it recorded today. So on the markets last week, pretty flat in the major indices. We saw the Dow down 0.1% and the Nasdaq up 0.1%. So pretty much dead for the week. We saw the FTSE come off a little bit. That was down 0.9% on the week. We saw a little bit more of a fall in the likes of the DAX, which was down 1.6%, and the Nikkei, which was down 2.2%. That's probably due to the fact that these markets have had slightly bigger increase of late, so we're seeing a little bit of profit come off the table. But all in all, a good week and or rather a good month so far. The markets have been in a good place, and we're all pretty happy with our returns on our equities at the moment. On the currency side of things, during the week we saw the Feds decide to keep interest rates where they were, and I'll talk about that a little bit later. So in respect of that, we saw the US dollar fall, albeit fairly slightly against most major currencies. We saw the fall very slightly against the sterling to be at 130 from 129 in the week. We saw the euro at 113 against 111. That was a 1.3% fall in the US dollar. And we saw it fall 1% against the Japanese yen to be at 100. The Aussie dollar remained pretty much the same, 76 cents is the rate against the Aussie dollar. So oil, a lot of people ask me, about oil and where to invest in it and why to invest in it. But as you know from my philosophies, I tend to stay away from oil. And I think the last month or so's volatility based on manipulation, basically, is as good a reason as any. I mean, don't get me wrong, we've seen it go from $39 to 48 this month, and then it was back up at 50 again a couple of months ago. And this is a day trader's dream. And if you like being a day trader and you're in and out of the markets, fantastic. But that's not what I do. I'm into long-term, sustainable, steady growth in my client portfolios. And for me, the manipulation that goes on in the oil market causes too many spikes and too many volatilities. So that's why I tend to stay away from it. I mean, for instance, we're talking about an OPEC freeze now, which is why we've seen it go up. Again, just people deciding what's happening. Yet during July, we saw the Saudis pump out 10.7 billion barrels a day. Sorry, 10.7 million barrels a day, which was a record. So you can see how different countries that are oil producers are able to manipulate this market, and of course also political factors come into play. So again, going back to my old staples that I like, where the money should be: consumer, healthcare, tech, and I'll chuck three shares at you to keep an eye on, which I like at the moment. Diageo in the consumer space, drinks company Johnnie Walker, Johnson & Johnson, everyone in the world should own, increased its dividend for 42 years. Every single year. And in the tech space, Amazon, I think, is the star of the show, albeit, of course, Facebook, Google, Microsoft, Apple, all of these companies are all worth owning as well. So on the sporting front, we've seen the Olympics come to an end. I think it was a fantastic performance by Team GB. The stars of the show, 4 years on from London, were the same stars of the show back in London. The likes of Usain Bolt, the triple, something incredible. And Mo Farah, I mean, absolutely incredible. I think a knighthood's on its way for Sir Mo, given what he's done in the last two Olympic Games. So to end with, I'm going to just end with a quote from Warren Buffett. I know we talk about Warren Buffett quotes a lot, but he's got a lot of good ones. And this kind of plays into what a lot of people's pensions are, and how by using myself or QRops to help manage your pension, I believe you can make better gains than in the pension companies that are already out there. He says wide diversification is only required when investors do not understand what they're doing. So what that means basically is you don't need to have your investments spread across every single sector. You just need to be in the right sectors, and you need to be in the right companies in those sectors. And that's why often pension funds are too well hedged, so you don't see the growth you should. Whereas if you can pick the right sectors of the market and you can move with that, you've got much more chance of making some money and growing the hard-earned pot of cash or your hard-earned pension pot which is obviously what the goal is for all of us. Anyway, I'm off to play golf now, so enjoy your week. If you need anything, please come back to me. Cheers, have a nice day. Bye.